Hello, good morning. So today we're going to look at financial and operating leverage. Areas that we are going to cover include what is leverage, break-even analysis, operating leverage, risk analysis of leverage, financial leverage, indifferent point, combined or total leverage. Okay? Here is the learning outcome. You can go through these. These are what we will cover this morning. So, leverage in a business. Leverage is using fixed cost to magnify the potential return of profit. So what do we mean by that? Is you can use fixed cost to increase the potential for the profit, for the company to earn a greater profit, for the company to become more profitable. You can use leverage to do that. Now, there are two types of fixed costs. There's fixed costs associated with operations, and these usually include fixed costs such as rent and amortization. Then there's fixed costs associated with financial costs, and that's costs such as interest on debt. From a balance sheet perspective, those costs can be looked at in terms of your assets. You have your current assets, your capital assets. Those costs related to operating costs can be looked at from the balance sheet side there, and in terms of financial leverage, we look at liability and equity, where those costs would be like the mixture of debt versus equity. So if you increase your debt, you will be increasing your interest charges, or if you decrease your debt, you'll be decreasing that interest charges. Now, there are two types of leverage. Right? There's operating leverage and there's financial leverage. So the degree to which capital assets and associated fixed costs are utilized are what's operating leverage. On the other hand, financial leverage is the amount of debt that is used in the capital structure of the firm. So it's a mix of debt versus equity. Now, remember that we usually use in preparing our income statement, we prepare our income statement by having sales. So if we have sales, let's say of 160,000 in this case, then from sales we normally take our cost of goods sold, and then we come to our gross profit, from which we will take our operating expenses, and then we come to earnings before interest and taxes, otherwise known as operating income. This income statement, however, is a bit different. This time we are going to break our sales, our costs down into fixed and variable costs. So we start with sales. From sales, we are going to take our variable costs, and then we will come to what is known as contribution margin. From contribution margin, we are going to take fixed costs, and from that fixed cost, then we will come to our operating income, our earnings before interest and taxes, from which we will take our interest and taxes to come to our earnings before taxes, which then we take our taxes and we have earnings after taxes. If we have total shares in units of 8,000, we can then find our earnings per share as the earnings after taxes are divided by the number of shares outstanding. In this case, it's 8,000, and it gives us an earnings per share of $1.50. Now, as far as operating leverage and financial leverage is concerned, with our income statement, we can break it down. right? So you will see that the upper half of our income statement is concerned with operating leverage, right? We have contribution margin and we have operating income, right? And the lower half of our income statement is where the focus is for financial leverage. So from our earnings before interest and taxes and down to our earnings per share is where the focus is for financial leverage. So let's talk a little bit about break-even analysis. So first of all, a firm operating costs can be classified into fixed, variable, and semi-variable. So fixed costs are those costs that remain the same over the short run. So it means that within a period, usually up to say a year, these costs cannot be changed. If you have a lease agreement, it may not be able to change before a certain time, which means that you are forced to pay this lease amount. And if you want to get out of that lease agreement, there may be costs associated with that, which could actually be higher than the cost. If let's say you're in a 5-year lease, then for you to get out after a year, you may have to end up paying for 2 years, for example. So it's like operating for 2 years before you're able to get out. So these fixed costs are, in the short run, you are unable to change. They don't vary with production. These like rent, amortization, executive salaries, property taxes. Variable costs, on the other hand, are those costs that change as production or sales changes. Raw material, factory, labor, sales commission. For example, if you're going to produce more goods, then you will have to increase the number of raw material. If you're producing more goods, you may need to employ more labor. So these will vary with production. We also have what's called semi-variable, which are those costs that may change, but they're not directly related to production. So, for example, utilities, repairs, or maintenance. For our purposes, however, we are going to consider semi-variable to be variable, so it will be combined with variable. So our focus will be on fixed and variable costs. So break-even is a technique used to study the effects of sales volume on cost and profit. So as sales changes, as sales increase, for example, it will have an effect on cost and profit. Alright? So the interesting sales volume is the break-even. Break-even. Break-even where there is no cost, nor where there is no loss or profit. So profit is equal to 0. So the interesting sales volume is the break-even sales level, at which a firm total revenue equals the total cost. That is, the firm does not make money or the firm does not lose money. So that's the interesting point here that a break-even analysis focuses on. So how do we find break-even? Break-even is equal to fixed cost divided by contribution margin. Alright? And remember, here in our calculations, we show you how we find contribution margin. So contribution margin, as you can see, our third line here, that it is sales minus variable cost, then gives us contribution margin. So therefore it can be written as fixed cost FC minus price minus variable cost. And then it's also equal to fixed cost over contribution margin. from a graphical perspective, here we have our break-even chart. Now, we have revenue or cost on our vertical axis, and on our horizontal axis, we have unit produced and sold. So, interestingly, in this case, in this graph here, our example shows that fixed costs represent $60,000, and our total cost starts at $60,000 and grows up, as you can see from the red line that shows our total cost line. So because there is fixed cost, total cost doesn't start from zero. It starts at $60,000. So if production or sales is zero, fixed costs, a total cost will be $60,000. Right? As production and sales increases, you will see that total cost starts to grow from $60,000 upward. Now, on the other hand, total revenue starts from zero. So if there's no production, no sales, then total revenue is zero. So if a company produces no goods, it will have zero revenue, but it will have total cost of $60,000. Right? So that total revenue line, which is the green line, you can see starts from zero and it continues to grow. Now, at the point where 50,000 units are produced and sold, that's what our break-even point is. So 50,000 units produced and sold will be how many units we need to produce and sell to break even. On the other hand, it means that break even in dollars would mean that we'll have to make $100,000 in sale to break even. So break even can be represented in units or dollars. So if, for example, a question can say, how much in dollars is the break even amount? So you give, in this example, it will be $100,000. Could be how many units? In units as a break even, and it would be 50,000 units. Alright? So here we can look at a table of what we are talking about. So now at the top end of the table, you will see that if units produced was zero, then our total variable cost would be zero, but our fixed cost would be $60,000. Total cost would therefore be $60,000, total revenue zero, and our operating loss would be $60,000. Likewise, if 20,000 units were produced, then our total variable cost would now be $16,000. Fixed cost will remain the same, it doesn't change, $60,000, and to that, therefore, our total cost would be $76,000. So total revenue would be $40,000 and our loss would be reduced from $60,000 to $36,000. So you can see at 50,000 units, which is our break-even units, we have total variable cost of $40,000, total fixed cost of $60,000, so our total cost would be $100,000. Our total revenue at that point will also be $100,000, which means that our operating profit would be zero. Right? So our profit at that point would be zero, and hence we'll be breaking even. So you will see as we increase production or sales, or increase the number of units sold from 50 to 60, we are now start to see profit. And as it's increased, as it continues to increase, the profit continues to grow. This is because we are making an assumption here that this is a linear relationship between profit and sales. So you can see that's why these lines are straight lines, because it's representing that linear relationship. Graphically again, we're looking at, and we can show here that if the firm was a conservative firm, so conservative meaning they are low risk firm, not looking to borrow so much, so their financial leverage is lower because they're taking on a lower amount of debt, they're not borrowing so much, or they're not looking to expand so much, so they're not building out or renting new spaces or taking on new equipment, so it's a conservative firm. They are not looking to grow as quickly. This firm would have a lower fixed cost. So a lower fixed cost would mean a lower break-even point. So rather than need to sell 50,000 units to break even, as in this example here, a more conservative firm would need to sell 30,000 units to break even, and the revenue that would be $60,000. This more conservative firm would need to generate $60,000 to break even. So here is where part of the issue. So break even would be less, which means that this firm would be less exposed than a less conservative firm than represented by this chart. However, notice that that area shaded in pink is a much larger area than for the more conservative firm, because it means that if the firm was unable to generate enough revenue by making enough sales, then its losses would be less if you are conservative versus a case where the firm is less conservative. However, if above that break even, where the firm is able to make sales and generate sales, you see that profit continues to widen here for the less conservative firm, the firm that's willing to take more risk, that profit will grow much wider compared to the more conservative firm. The area shaded in green represents profit, and you can see that if the firm take more risk and it's good times, then that firm will be able to do much better than a more conservative firm that didn't take all that risk, but that the more conservative firm would better able to work itself through difficult times. So if you think about the environment in which we are operating now, where there's COVID-19 taking place, a firm that chooses to become more conservative will be better suitable for time like this. They'll better able to survive now than a firm that is less conservative and choose to take on more debt, purchase more equipment, build, lease or build more factory. So, the conservative firm would be better able to survive through difficult times right now. Here is the table as per previous table for the less conservative firm. We can see in the situation of a more conservative firm that at 0 units, fixed cost would be $12,000, so total cost would be $12,000, and the loss of that firm would be only $12,000. At $20,000, the firm variable cost would be $32,000, and fixed cost of 12, so total cost would be 44. The firm would only be losing $4,000. At break even, 30,000 units would be required to break even. And that 30,000 units, right, would have total variable cost of 48,000 plus its fixed cost of 12,000 for a total cost of 60,000. So if a company is able to generate $60,000 in revenue, it will break even. For it to generate $60,000 in revenue, it will need to sell 30,000 units. Now, above 30,000 units, just as in the case of the more risky firm, firm will show profit. However, you can see that the profit in this conservative firm does not increase as rapidly or as fast as the less conservative firm. You will see here that a less conservative firm, 12,000, 36,000, 60,000 in profit, compare with a less conservative firm, with a more conservative firm where profit is only 4,000, 12,000, 28,000, and so on. So, profit, if the company can use leverage to magnify its profit, however, that leverage could also be a problem if the firm is unable to generate that income that it was forecasting to make when it decided to take out new debt and purchase new equipment and so on. So, measuring the amount of fixed operating costs used by a firm, that's that operating leverage does. It measures the amount of fixed operating costs used by a firm. So the degree of operating leverage is equal to what? The percentage change in operating income over the percentage change in unit, right? The degree of operating leverage is equal to percentage change in operating income divided by percentage change in units. So a change in sales will bring a larger change in sales bring a larger change in earnings before interest and taxes, which is our EBIT, or operating income, if the degree of operating leverage, or DOL, is greater than 1. So if DOL is greater than 1, you will see that a change in sales will bring about greater change in earnings before taxes. So, in other words, DOL measures the sensitivity of a firm's operating income to change in sales. So it measures the sensitivity of a firm's operating income to change in sales. So with DOL greater than 1, it's going to have a greater impact. Changes in sales will have greater impact on our operating income. So that operating income could be, if this an operating loss, then it will be greater. If it's operating profit, it will be greater, that change, if the degree of operating income, leverage, is greater than 1. So, a high leverage firm has high fixed costs, as we showed you in those two examples of the risky firm versus a more conservative firm. So a high leverage firm would be more risky, so it have higher fixed costs, high break-even point. So you notice that break-even point was all the way up to 50,000 units or $100,000 in sales, and a high degree of leverage. So the degree of leverage would be greater in the case of the less conservative firm. So a non-leveraged firm, or not a firm with smaller leverage, has lower fixed cost, lower break-even point, and a lower degree of operating leverage. So leverage is a double-edged sword. As we said before, it's a double-edged sword because on one hand it can be used to magnify profit, but leverage can also magnify losses. If in bad times you are not able to make the sales, then your losses will be magnified if the degree of operating leverage is high, versus in good times where if your degree of operating leverage is high, then the company will do well. So it is a double-edged sword. It magnifies losses as well as profits. So here are our two firms together, showing our high leverage firm versus our conservative firm. And you can see that at 0 units, one firm is losing $12,000, our conservative firm, while our leverage firm is losing $60,000. At 20,000 units, the highly leveraged firm is losing 36,000 versus a conservative firm losing only $4,000. And same can be said at 40,000 units. Again, now the conservative firm is making a profit. Right? At 40,000 units, conservative firm is already making a profit, but the highly leveraged firm is still losing money. So it's only at the 60,000 units is when the highly leveraged firm is no longer losing money. So no, sorry, I should say at $50,000 it would be actually be breaking even for the highly leveraged firm. And now at 60,000 units, both of them would be making the same amount of profit. So this point would be considered to be an indifferent point, where if you are able to operate at this number of units, then there would be no difference between the highly leveraged firm versus the more conservative firm. At 80,000 units, the highly leveraged firm's profit is far outdoing the conservative firm. And you can see at $100,000 sales in unit, you find it's even greater profit being made by the highly leveraged firm versus the more conservative firm. Now, for the most part, we have been assuming that there is a linear relationship between production and sales versus revenue and cost. As you can see here, the lines are very straight in this case. But there may not always be a straight line. There could be some nonlinearity occurring. Now, that nonlinearity may due to the fact that if you're selling above a certain point, you'll find that there may be suppression in revenue, and revenue will not be able to grow at that linear rate, that the assumption that we have made before that it will be linear, and so the curve changes a little bit. And the same thing could be said for cost. If you above a certain cost, you may find that that non-linearity doesn't exist. But within, if you can see here from our valid area, this area is showing that within this area we may be able to use our break-even analysis, as it may offer some level of linearity within this area. So let's talk about financial leverage. We have been talking about operating leverage so far, so let's look a little bit at financial leverage. So it measures the amount of debt used by a firm. As we said, it's a debt equity mix. So the degree of financial leverage is the percentage change in earnings per share. Remember, we said earlier that financial leverage is concerned with earnings before interest and taxes all the way down to earnings per share. So now we are seeing where that comes in when we look at our degree of financial leverage. Earning percentage change in earnings per share divided by percentage change in earnings before interest and taxes. So a change in earnings before interest and taxes or operating income brings a larger change in earnings per share if the degree of financial leverage is greater than 1. So if the degree of financial leverage greater than 1, then we would be expecting that there would be a greater change in earnings per share versus a change in our EBIT. So degree of financial leverage measures the sensitivity of a firm's earnings per share to changes in operating income. So for degree of financial leverage, right, we can find, and there's something wrong here with my formula, but this formula should read: the degree of financial leverage is equal to operating profit divided by earnings before interest and taxes. Right, and let me try fix this while we speak, so we're better able to see what this looks like. So let's see if I can just fix this right here. There you go. So you can see that our degree of financial leverage is equal to operating profit over earnings before interest and before taxes, sorry, not interest and taxes, but earnings before taxes, or EBIT divided by EBT. So we can look at the impact of financing plan on earnings per share, right? So if you have plan A, you have a conservative, a highly leveraged firm in A versus our more conservative firm in plan B. If at 0 EBIT, so if there's no operating profit is 0, then we will see that our earnings per share in this case, in the highly leveraged case, would be 0.75 cents versus 8 cents in the more conservative firm. At 12,000 units of sales, the earnings per share will be 0 for the highly leveraged firm. But the conservative firm is already showing that it has earnings per share of 17 cents, right? At $16,000 per sales, this indifferent point between the two, because they're both having the same earnings per share. At 36,000, now the highly leveraged firm is doing far better in earnings per share versus the more conservative firm. And again, it shows how that profit is actually, that profit ability, that ability for the company to generate more income is magnified when there is greater leverage. But that's also, losses will be also magnified when there is greater leverage. So the indifferent point. The indifferent point is the level of earnings per share at which alternative financing plan yield the same earnings per share. Right? And here is mathematically how you can always determine that indifferent point. You can determine that indifferent point where EBIT is the same for both. You can see that if we apply this formula where the sales of B company times just making sure that, okay, so there you go. Okay, so sales of B company times interest of A company minus sales of A company times interest of B company over B company sales minus minus sales of A company. We will then have our indifferent point between the two. Now, financing plan here, we can show again earnings per share for both both companies A and B, and we can show the indifferent point between the two, and you can see as you look at both plans that earnings per share of the more aggressive company is more steeper than the earnings per share of the more conservative firm. So although the more conservative firm, it has a more flatter line, which shows that it is not as aggressive, not as risky as the other company. So at the point of 0.25 cents earning per share or $16,000, that's where both are equal. So that's where the indifferent point is, where you're indifferent between both plans. So companies have borrowed have different degrees of leverage. So we can look at the financial leverage in this a selected industry. And the blue line, the blue blocks, it shows total debt to equity. And in the pink, it shows long-term debt to equity. And you will see that some companies are more comfortable in holding leverage because of how they generate revenue, right? Their revenue may be more stable, and hence they're better able to use leverage than companies that have not so stable revenue are unable to use leverage in the same amount. So different industry, for example, like the mining industry, you will see that if you look at their long-term debt to total equity is far less versus, say, the real estate or in the accommodation industry. So now, operating and financial leverage. Here we have both in our same table showing from the start our sales variable cost in terms of units, 100,000 units being sold in one case here, and 80,000 units in the other. So you will see that with 80,000 units, we generate a sale of 160,000. With 100,000 units, we generate sales of 200,000. Now, excuse me. So variable cost in terms of unit would be 80 cents per unit. So if 80,000 units are sold, let's focus on the 80,000 line for now. So if 80,000 units are sold, the variable cost would be 64,000. We produce a contribution margin of 96,000. Then we will have fixed costs of 60,000 to have our earnings before interest and taxes or EBIT of $36,000. From that, we'll take interest, which is our fixed cost relating to financing, and we'll have our earnings before taxes, from which we'll take our taxes to have our earnings after taxes, and with shares a gain of $8,001.50 per share. Equally, if we have 100,000 units, we would apply the same way, but the difference is now that earnings per share would change. Equally, our contribution margin would be different. We have $100,000 in contribution, $120,000 contribution margin because the number of units sold increases. And then we also have operating income, EBIT, being higher because we have sold more units. So we can combine both leverage in what we consider to be what we speak of as degree of combined leverage. So combining operating and financial leverage, right? We know we have the operating side of it that deals with the operating leverage, and then we have the financial part that deals with financial leverage. So we can look at the overall leverage of the business by combining operating leverage and financial leverage. So combine our total leverage represent the maximum amount of leverage because we're combining the operating and the financial leverage. So the degree of combined leverage is equal to the percentage change in earnings per share over the percentage change in sales volume. So a change in sale will bring a larger change in earnings per share if the degree of combined leverage is greater than 1. So it is following the same principle, right? So how can we find the degree of combined leverage? Degree of combined leverage will be equal to the degree of operating leverage multiplied by the degree of financial leverage. So that's one way of finding that. So here are our formulas. We have the break-even formula. We have our degree of combined leverage. We have our degree of financial leverage. We have how we find that the indifferent point where you're indifferent between different plans based on the EBIT that would be generated. And we have our degree of combined leverage being equal to degree of operating leverage multiplied by degree of financial leverage. So, leverage refers to the use of fixed cost to magnify profit, and it may also magnify loss of a firm. So it is a double-edged sword, right? Because it's in good times it will be great for us, but in bad times it could be risky. So management must be sure of the level of risk it's assumed, it's taken on. So because leverage can be good as well as leverage can be bad. So operating leverage refers to the use of fixed operating costs such as lease or amortization expense versus the degree of operating leverage refers to the use of fixed operating costs such as lease or amortization. The degree of operating leverage measures a percentage change in income as a result of a percentage change in sales. So how does operating income changes as sales change? That's what we are measuring in terms of the degree of operating leverage. Financial leverage refers to the mix of financing charges such as interest, costs, and debt, because it looks at the mix of debt versus equity. So the degree of financial leverage measures the percentage change in earnings per share as a result of percentage change in operating income. So how does earnings per share change as operating income changes will tell us what is the degree of financial leverage. So the higher the level of fixed costs, both in operating and financing, the greater the effect on net income of increases in sales revenue. Right? So the higher the degree of these costs, if you have a lot of fixed costs carrying, there as you increase production, as you increase sales, your sales volume will go up. But if you're carrying these fixed costs and you're not making sales, then your profit is going to be below, your losses is going to be high, I should say, right? If you carry this fixed cost, you're not making sales, you're unable to meet your break-even target per se, then your losses are going to be much higher. It will be difficult to reach much harder to reach your break-even point than if you were carrying much lower fixed costs. Okay guys, so that comes to the end of our slides presentation. So our next step will be to do some practice questions. That's what we will be working on during class when we meet. So I want you guys to take the time and go through the slides, go through the lecture, and then we will meet and look at the questions and try to work through these questions. Okay, so see you guys. Have a good rest of the day.